Hi, and welcome to my channel. For those of you new, my name is Dave, and I work in financial services, and these videos are a mixture and journey towards my financial freedom. They will cover financial products, and they will also cover financial well-being so you, like me, can reach your goals and aims sometime in the future. Now let's get into this latest video. Well, 2022 hasn't been the greatest year for investing due to a number of collective factors. Rising inflation around the world, supply and demand issues, whether that be shortage of chips to build electronic items, cars, shortage of food, or the rising cost of certain commodities. Now, this has resulted in a collective negative response on stock markets globally as markets hate uncertainty. Over the past decade, we have seen record low inflation rates, which has produced a rampant economy and spiralling debt, both for individuals, also governments, because it's been easy and cheap to get credit finance. And obviously, the major economies have just continued to print money to stimulate growth after the so-called pandemic. Now, unfortunately, though, this is all caught up with market sentiment, resulting in asset prices being greatly reduced over the past 12 months, and also about the possibility of an impending recession. It is believed that 70% of GDP is produced by consumerism and people's spending habits. If we look at the following chart, a quick overview of what's happened to the market this year to date, or the past 12 months. So first of all, the FTSE 100. Now we started the year, the index had a value of 7,403. It's now at a level of 6,858 at the time of this video, a drop of 545 points, resulting in a year-to-date loss of 7.4%. Now this though hasn't been as bad as other major indices. If you look at the second chart, how the S&P 500 has done, so considered to be the biggest stock market in the world. Started the year at 4,778, now down at 3,583, a drop of 1,195 points, resulting in a year-to-date loss of 25%. Now, ultimately, how people react to these latest events and figures will no doubt be a major factor on your investment returns in future. It may well be a short-term blip, or the markets may stay depressed for the next 12-18 months, but can you take advantage of the so-called Great Reset, or see it as a buying opportunity which will pay off handsomely over the coming years? In the past, we've seen other major market downturns this century, such as the 2008 banking crisis, the pandemic in 2020. If you'd invested the MSCI World Index since 2000 until the end of last month, you would have received an annual return of 6.5%. The FTSE All-Share return would have been 4.2%, and the S&P 500 would have delivered an annual return of 7.5%. So think of it, so to say, across numerous years, not just a short-term scenario. This just proves there will be good months, there will be bad months. There will be good years, there will be bad years. But by staying invested in the market across a long time frame, it will ultimately pay off. The most important factor is time in the market versus timing the market. Now, even the best fund managers and so-called investment professionals cannot time the market. Some may get lucky by certain shares or investment types, but the vast majority of managers fail to beat the market benchmark on an annual consistent basis. If you think further afield over numerous years, the S&P 500 has produced annual returns since inception of over 8% per year. Now, most investors should continue to dollar cost or pound cost average and buy good quality shares, funds, ETFs, and hold them for the long term. Now, me personally, I last sold my share in 2020. A share at over 100% profit because the management had changed and I reduced my holdings and I put it into a different asset. But all the shares, the funds, the ETFs I hold, I intend to hold for the next 3 to 5 years. And they will produce nice dividends, which will be reinvested. Okay. And at the moment, I'm buying more shares at a greater reduced price. So it will, shall we say, bring my average price of those shares down in value. Now, I do see myself as some kind of long-term or contrarian investor. One big concern I do have, though, as part of my day-to-day job. Now, I speak to numerous people on a daily basis, whether it's face-to-face on the phone, about people who are accessing their pension pots. Okay? It frightened me to hear people on a regular basis who are saying they're concerned because their pot may have gone, say, from 50,000 down to 40,000. And they are considering access the money and putting the bank or building society as safe assets because they are concerned it will continue to lose money. Why? Because the media is full of negative stories on a daily basis. Unfortunately, bad news sells. If a portfolio goes from 100 to 110,000, everything's good, everything's rosy. If a portfolio goes from 100 to 90,000, fear and panic sets in. People are more risk averse and react when losing money than when they're actually producing profits. Remember, you may see a wall of red against your current investment prices, but a loss is only a loss on paper. It doesn't become crystallized until you actually sell that loss. Now, there are those in the market that see it as being rigged, the so-called 1%. This may be the large investment houses, hedge fund managers, who are seen to be driving prices down so they themselves can buy good quality stocks at reduced prices. This may lead to obviously large gains for themselves over the next few years and create some very good investment returns and profits. But most individuals or investors have a totally different mindset. They will sell assets when they start to lose value. They will exit the market. They will park that cash until market fear recedes. And what will they then do? They will then buy back into the market at a higher price. Okay, this is completely wrong, and it will also results in greater buying and selling costs, and it will have a really marked adverse effect on your overall portfolio return because of buying and selling costs. The world of investing shouldn't be considered aloof or complicated and out the reach of the normal person in the street. But the investment world wants to give you that impression it is complicated. It should not be. It should be relatively simple, shall we say. Now, if you think of all the great unsuccessful investors that have been over the numerous years, they have all been considered long-term buyers. And what do? They pick good quality stocks and shares that produce annual consistent results year on year on year. I can't think of any day trader or short-term buyer and seller who is considered an solid investment role model to the wider world of investments, who may have produced solid growth, not just over 1 year, but across numerous years consecutively. Now, the internet is full of so-called people promoting instant gratification, get-rich-quick schemes. The world of investing should be considered safe and boring. It is far better being in the market over numerous years and receiving steady returns year on year. And let your portfolio increase in value. One, due to constant contributions, okay, maybe on a monthly, quarterly, annual basis. It may well be all your dividends are reinvested in some kind of tax-free wrapper, okay. But also learn about the power of compounding. It will ultimately pay off in the medium or long term, so you, like me, can reach your financial goals and aims in the future if you remain focused, if you stay calm, if you create a plan. Avoid short-term market sentiment. Unfortunately, bad news sells. Remember, if you like the videos, subscribe to this channel so we can grow and reach a wider audience, and we'll see you in the next video.